The impact of natural disasters and global events. I get how central banks, interest rates, trade balances, and GDP can affect currencies, but what about unexpected stuff, like earthquakes, tsunamis, terrorist attacks, or even a pandemic? Do these things move the Forex market? Absolutely loser. These are called exogenous shocks. They're events that originate outside the economic system, but have a direct impact on markets. And yes, they can shake currencies sometimes violently. So they're like wild cards in the deck. Exactly. Let's break it down. There are two main types of these events. Natural disasters, like earthquakes, hurricanes, tsunamis, wildfires, floods, volcano eruptions. Global events, such as terrorist attacks, political coups, pandemics, cyber attacks, or large-scale conflicts. And the markets react badly to these? Markets hate uncertainty. And these events inject massive uncertainty. But the reaction depends on scale, location, duration, and timing. Let's go through them one by one. Let's say there's a big earthquake in Japan. What happens to the yen? Good example. Intuitively, you'd think the yen should weaken because the disaster damages infrastructure and economic output. But sometimes the yen strengthens in these moments. Wait, why would it go up? Because of something called repatriation flows. Japanese insurance companies and investors bring money back home to cover costs. They sell foreign assets and convert them to yen. That creates demand for the yen and boosts its value. So even a destructive event could temporarily strengthen a currency. Correct. The short-term reaction often differs from the long-term trend. In the long term, the damage to GDP, productivity, and investment confidence could weaken the currency. What about countries that rely on tourism? A hurricane hits the Caribbean, what happens to their currency? Tourism revenue falls, that reduces foreign currency inflow. The local currency may weaken due to lower export earnings. In small, tourism-dependent economies, even a single event can cause severe depreciation. Let's talk about big global events like terrorist attacks or pandemics. These events usually cause a risk-off reaction. Traders pull out of riskier assets and rush to safe haven currencies like the US dollar, Japanese, yen, or Swiss franc. Why those three? They're seen as stable, liquid, and backed by governments with strong institutions. When fear spikes, traders seek safety. So during COVID-19, people bought the dollar? Yes. In March 2020, the US dollar surged as global panic erupted. Even though the crisis started in the West, everyone rushed to USD because it's the global reserve currency. Interesting. So even if the US is affected, its currency can still rise in a crisis. Moneymaker. Yep, that's the paradox of fear in Forex. It's not about who is hurt. It's about who is less risky or more liquid. What about political instability, like coups or mass protests? They hurt investor confidence. Capital flees unstable environments. Currencies drop fast. In 2016, after the failed coup in Turkey, the Turkish lira plunged. Investors hate political uncertainty and cyber attacks. Right, if they target infrastructure or financial institutions, they can cause panic. A major attack on a central bank or payment system could trigger a currency sell-off. So it's all about trust and confidence. You nailed it. Currency values are at their core confidence indicators. If people lose faith in a country's stability economically or politically, they dump its currency. You said the short-term and long-term effects can differ. Yes. For example, a natural disaster might cause immediate repatriation and strengthen a currency short-term. But over time, the loss in GDP, investor fear, and lower interest rates can lead to depreciation. So traders have to think in time frames. Always, short-term traders ride the immediate move. Long-term investors focus on fundamentals: economic growth, inflation, debt levels, policy reactions. What about government response? Does that matter? Massively? A fast, coordinated response builds confidence. Slow or chaotic one worsens sentiment. Traders reward competence. These shocks seem unpredictable. They are. That's why traders use risk management. Tight stops, diversified exposure, and capital preservation are key during uncertain times. You can't predict earthquakes, but you can control your risk. Got it. Expect the unexpected and don't bet the farm. Exactly. Always know where your exits are. Aye. And remember, markets recover, but bad trades can knock you out permanently. So, to summarize, natural disasters, political crises, pandemics, they can all move currencies through different mechanisms like repatriation, fear, or damage to trade and confidence. You got it? And your job as a trader is to understand not just the event, but how others will react to it.